Welcome, everyone. I'm going to give our audience today a moment to join us, and then we are going to jump into today's webinar. We have a lot to go through. There's a lot of exciting content that the team has prepared for you. So with that, we're going to get started. Welcome. My name is Allison LaForgia. I am HW Media's Senior Webinar and Events Manager. And today we are going over QC trends and how to prepare for the next generation of GSE reporting. Now, a few housekeeping items before we get started and before I introduce our panel. We will be having a Q&A session towards the end of the webinar. You can submit questions at any time by clicking on the Q&A icon at the bottom of your screen. You will also be able to see the recording in the next few days. So if there's any part that you miss, if you think that your team should check things out, make sure that you keep an eye out on your inbox for that. Now, today we have a panel of absolute industry all-stars with us. Each one of these panelists is an award winner. So I'm just going to give you guys a quick introduction as to who's joining us today, and then I'm going to hand things over to the ACES team to get started with today's content. Now, our first panelist is Nick Volpe. He's the EVP of Key Accounts at ACES. He is a winner of the HousingWire's Insiders Award. He has over 20 years of experience in both mortgage and origination and servicing. He was a part of the original team at the Murray Hill Company and was integral in pioneering credit risk oversight for mortgage loan securitizations. Prior to being at ACES, he helped establish origination and servicing QC businesses, as well as lead integration teams in multiple acquisitions. He's a recognized subject matter expert and has authored the QC Mortgage Trends Report and speaks regularly at industry events. We also have Phil McCall, who is currently the President and Chief Operating Officer at ACES Quality Management, another award winner. He's won the HousingWire's Vanguard Award, as well as the Banking Tech All-Star Award. He brings over 2 decades of executive experience from the mortgage industry to ACES. He is an award-winning, seasoned expert in quality control, loan origination and underwriting, mortgage fraud, loss and litigation, as well as real estate-based transactions. And last but by no means least, we have Sharon Reichart, who's the EVP of Operations at ACES. She is another award winner and has won the HousingWire Insiders Award, as well as the MPA Elite Women Award. She brings over 25 years of mortgage industry experience to ACES, most of which were spent as in the quality control department at Everbank. Her previous experience spans auditing loan servicing, origination compliance, consumer banking, and commercial real estate. And prior to joining ACES, she was Everbank's lead administrator and report writer, and the report writer for ACES. She served as QC audit coordinator for external audits, including FNMA, FHLMC, HUD, CFPB, and OCC, and was instrumental in improving business processes such as executive report writing, regulatory reporting, as well as quality assurance. Now, that gives you a little bit of color as to who's joining us for the call today. So with no more time spent on any sort of background, I'm going to hand things over to Nick, who's going to get us started. Nick, the floor is yours.
Thank you to everybody for joining us today, and special thanks to HousingWire for having us. We are pleased to be here with all of you today to show different metrics from our QC data, as well as talk about some industry topics. I am Nick Volpe, EVP of Key Accounts at ACES, and I'm joined by Phil McCall, the President of ACES, and we plan to go through the QC and industry trends portion of today's webinar. And a little bit later, we will be joined by Sharon Reichart, the EVP of Operations here at ACES, and she will take you through some timely and interesting topics related to the GSEs. There are 3 distinct parts of our presentation today, and we will start with analysis of QC trends while weaving in areas that we see as concerns going forward. The second part of the presentation will focus on current events in the mortgage industry and a preview of expected regulatory activity. And we will close out with some information on GSEs, including recent changes that were made to reporting and data sharing. In our reports, we always lead with this statement. It really describes the data, which is homogenized for standard post-close QC reviews and only includes critical defects, those that would make a loan ineligible for sale, delivery, guarantee, or insurance. But the true usefulness of the data is in the trends. In other words, where we are seeing across a broad base of lenders and data, things that you can apply to your own business. And being able to look at where the defects are coming from and give you the information you need to check your own book of business for problems. In today's presentation, we're going to look at the results for the fourth quarter of 2021, but also the full calendar year. We will start with the overall critical defect trend. The rate came in at 1.95% for the fourth quarter. That's an increase of just over 4% from last quarter's 1.87%. As you can see from the chart, the first and second quarter were brutal. And if there's one piece of good news, it's that the defects declined in a meaningful way in the back half of the year. Phil, what happened in Q2 of 2021?
Well, Nick, I think the second quarter of 2021 was the outlier that really drove the average defect higher for 2021. If we look back to Q3 and Q4 of 2020, defects had shot well past the 2% mark, and overall were running a bit higher than the previous years. A lot of movement was happening in Q2 with a big turn in the market as we started to see transition away from refinances and into this purchase market. Now, with all that went on throughout the year, we did see an unexpected drop in rates. It did spur one last boost to the refinance business. But back to Q2 as an outlier. There were two key things I think that were happening. One, the average mortgage interest rate hit 3%, and that was after a prolonged period of low rates. And two, the share of purchase transactions overtook the refinance transactions in the ACES software. Now, with all that went on throughout the year, we did see an unexpected drop in rates later in the year, which did spur that one last boost in refinance business. And I think that does align with the drop in critical defects we're seeing. So overall, the critical defect rate, at the end of the day, was a little higher than you'd like to see. But as we close out 2021, this rate was not too far out of line with historical data.
Great. And in the next slide here, you will see the same defect rate by quarter that's in the previous slide, but we added in the rates for 2020 as well. This slide gives you quarterly defect rates really for the entire pandemic. The blue line is 2021 defect rates, and the green line is defect rates by quarter for 2020. You will see that defects were 1.56% prior to COVID, and it's been a bit of a struggle since COVID hit in Q2 of 2020. We haven't been able to consistently maintain that 2% or better level ever since. And then on this next slide is the last piece of data on the overall critical defect rate. And what we're showing here is the average critical defect rate by year for the last several. You will see that in 2021, that was the highest year on record. And while 2021 was just slightly higher than 2020, it was around 20% higher than before the pandemic. So that's definitely a trend that we don't like to see. Phil, give us some final thoughts on the overall critical defect rates.
Sure enough. Historically, when defect rates creep up, typically you can align the increase with lenders adjusting their risk tolerance due to a changing market. Again, this is most commonly seen when there's a reduction in overall production. And as an adjustment to those changes, lenders are open to taking on a bit more risk. They're working hard to qualify borrowers, some which may have marginal profiles. And as a result, we tend to see defects rise a bit. And lenders are free to make those decisions based on their own risk profile, meaning there's nothing wrong with that at all. It's normal and customary. But I don't necessarily believe that's the case we're looking at here. The reason for that is the environment that we were in during 2020, 2021, lenders were doing really well. Volumes were exploding. So we believe the higher defect rates over the past several years were due to volumes, staffing, and COVID-related concerns. And so really, where we need to be careful going forward is today's market is where the past cycles we would see lenders take more risk, try to keep volumes up while making staffing adjustments and other measures to maintain profitability. We definitely don't want to see defect rates going any higher, and there will be a heightened concern if we see that at the beginning of the trend with our Q1 2022 data.
Yeah, well said, Phil. I think I agree with you that during the good part of the cycle, we typically see lower critical defect rates, and then towards the end, as lenders are fighting for volume, we see those defect rates creep up. So it's a little concerning that they've already crept up, largely due, as you mentioned, to COVID. But now that we're at the end of the cycle, if lenders take more risk and that goes even higher, that would be something that's, of concern. So let's take a look at where these defects are coming from. So this next slide looks at defect by Fannie Mae category. If you follow the QC Trends report, you'll notice a familiar theme for the fourth quarter. That's the income and employment category, again, making up the largest share of defects. And they were 27% of all defects in the fourth quarter. There is some positive developments on this front, which we'll go into in the next slide. But really going back to 2019, that category has led all defects. Elsewhere, we always focus on the big four: assets, credit, liabilities, and income. We use the term big four to differentiate key borrower health categories from the other categories that we broadly lump into manufacturing related categories. In those latest quarter, the big four makes up 62% of all defects. And then the next slide shows very similar data, although it compares defect share by category for the latest quarter and the prior quarter. So sticking with that big four theme, those categories were 64% last quarter. So the 62% share in this quarter is a slight improvement. The income and assets categories declined quarter over quarter, while the credit and liabilities categories had an increase in their share. Overall, in the fourth quarter, 4 categories had increases in defect rates compared to the prior quarter, and 6 quarters saw their share of defects decline. In the increase front, the appraisal category stands out the most. Appraisal defects have been really low throughout this latest refinance cycle. That they rose in Q4 is something to note. And with interest rates where they are today, it is possible that affordability concerns could impact property values now and into the near future. QC managers should make sure the QC process is accounting for true valuation issues and not just workmanship errors. All right, this next one is the last slide on defect categories. This one is showing defect by categories, comparing the full calendar years of 2020 and 2021. We won't beat the income category to death, but the increase year over year bears another mention. It is clearly the area that lenders are struggling with the most. If you look at categories that are manufacturing related, the 2 categories in the lead there are compliance and loan documentation. As you would expect, the share of compliance defects improved in 2021. There's no question that 2020 was a difficult year for origination compliance with all of the COVID-related changes and state-level executive orders to help with the pandemic. So the decline there was a welcome change. The defect share of loan documentation declined as well, although they still remain high as lenders have struggled with the pace and extended turn times due to high volume. Phil, help us close out the category discussion.
Nick, there's some great information here, but I do want to touch back on the income category for just a moment. We know that properly documenting and calculating a borrower's employment and income can be the single hardest part of underwriting a mortgage loan. And if we look back to 2020, we know COVID made getting proof of income much harder earlier on. But that shouldn't have been an issue in 2021. We know fintech vendors have been investing hundreds of millions of dollars in this space. And so the point is, it's concerning that not only is income and employment the top defect category by a huge margin, but also that the share of defects in this area is growing year over year. Going forward, I'd like to see the income and employment go back to its historical level in the low 20s. As I assess the overall view of the critical defects by category, and aside from the income and employment category I noted, what I think we should be watching closely is how the change in product mix from refinance environment, and we've been hot and heavy the past 2 years, to this new purchase-driven environment. And along with the lower overall volumes, will affect the defect share by category.
Yeah, Phil, you brought up a very good point, and that's a nice segue to our next slide. We were able to break down some of the key categories into the subcategory. Subcategories are the specific issues that make up the category, and they help give you a view of what the specific issues are in each overall category. And you see that documentation of income, credit, and assets makes up a substantial portion of the defects in the overall categories. So what was one of the biggest pain points during the refinance boom? Well, it was turn times, right? So some of those were 90 days or more during various parts of this last cycle. Well, when we see extended turn times, we see that income documentation, credit letters, and asset statements that are used in qualifying the borrower, those expire. A 4-month-old pay stub isn't valid documentation for a borrower's income. So it would make sense, or some sense, I should say, to see this in 2020, particularly in Q2, where COVID sent everyone home for the first time. Very hard to get people on the phone to document income and send the proper documentation. But to continue to see it into 2021 is a red flag. And then the last point is similar to what Phil said. The income calc is the most complex and error-prone part of the underwriting process. This data reflects that, with about 34% of the defects in the largest defect category being the income calc. So still a big portion of the defects there. I would say, so everyone out there, get focused on this. Make sure the QC feedback gets to your credit and underwriting teams. It's very important, and this is where lenders overall are struggling the most. The next set of data is to look at defects by loan purpose. The results here reflect the environment that we're in. We see in Q4 that reviews on purchase loans were in the solid majority and actually increased their share from the prior quarter's 57%. That is a trend that we saw for the first time in QC data in Q2. And we expect that trend to continue for the near future. The metric to pay attention to on loan purpose is the right side of the slide. That will tell you, relative to the review share, where the defects were. If the percentages on both sides are equal, that tells you that the review share and the defect shares were roughly equal. For Q4, the percentage of defects was higher than the percentage of review share for purchases. Purchases are not only dominating reviews, but also defects is what that means. Purchases made up 66% of all defects, about 6 points higher than the review share. And when defects on purchases climb, that by default means defect share on refinance transactions has to fall. We saw that in Q4 2021, where refinances made up 40% of the reviews, but only 34% of the defects. The next slide shows the same data, not just for Q4, but for the entire calendar year. Here, the numbers are much tighter with refinances and purchases closer in both review share and share of defects. This is reflective of much of 2021 being a refinance market, and you can see how quickly things change in the defects and share once purchase lending picks up. Phil, anything to add on loan purpose?
I would say our expectation is that the trends here continue. Historically, purchases are going to make up a larger percentage of the defects. They're just more complicated loans to originate. What we saw during the pandemic and the corresponding refinance boom is that refinances dominated both the share as well as the defects. And that was most likely because of the sheer volume, pressure on lenders to originate at those mass volume amounts. So the perceived degradation of quality in purchase loans is hopefully just a sign of things getting a little bit back to normal. We'll keep an eye on the metric, but I'm not ready to proclaim this is any type of a red flag at the moment.
All right, so we've arrived at the last set of data for QC trends. This data looks at review share and defect share by loan type for the fourth quarter. No surprise here, conventional loans just dominated as far as share. 2/3 of all loans put through the ACES software were conventional. The share is down slightly from the prior quarter and continues the trend of conventionals creeping down in share each quarter. As we get further and further away from the peak of the refinance cycle, we would expect the conventional share to stay in the low 60s. And for FHA to absorb the majority of that volume and rise to the mid to high 20s. The big change in the fourth quarter was in performance. Throughout the pandemic and the refinance boom, we saw anomalies in conventional lending performance where the defect share was actually above the review share. Historically speaking, the share of defects on conventional loans runs about 10 points lower than the review share. That metric appears to be moderating and reverting back to historical norms, as in this quarter, the defect share was 20 points lower than the review share, with FHA defects surging back into the picture. The data for the entire calendar year illustrates this point. The difference between the review share on the left and the defect share on the right is much tighter. And that is because in Q1 and Q2 of 2021, the defect share was much higher on conventionals before moderating in the back half of the year. The purchase market will continue to impact these numbers, and we expect the full calendar year of 2020 to look more like 2019 than the pandemic years of 2020 and 2021. This means lenders should pay special attention to their FHA loans as it is likely that defect share there rises. So that's going to conclude the critical defect and trending data for both Q4 and the full calendar year of 2021. As I look back on it, those were two of the weirdest years on record, both in general and for the mortgage industry. I'm sure some of us on this call are old enough to have lived through some pretty crazy disruptions in this industry. If you go all the way back to the attacks on September 11th, and if you recall, that tragic event happened in the midst of the bursting of the dot-com bubble. And then fast forward a few years to the credit crisis and the ensuing chaos around that. And then we had 7 or 8 years or so of relative calm, and then came COVID. What a ride it's been. Hopefully we haven't become numb to crazy events in our industry, because there are some challenges ahead. So let's talk about some of those. If you've been a follower of the QC Trends Report, you probably remember that for a while we were tracking EPD reviews conducted within the ACES software. There was some early worry that the no questions asked forbearance provisions of the CARES Act would manifest an outsized repurchase risk problem for lenders. So this chart tracked the number of EPD reviews conducted using a normal market as the benchmark. That benchmark was Q4 2019. We did see a rapid rise in EPD reviews in Q2 2020 before peaking fairly quickly in Q3 2020. Essentially, what this graph says is that EPD reviews doubled at the beginning of the pandemic before quickly leveling off. We stopped reporting this data later in 2021 as it became clear that EPDs had reverted back to or below historical norms. So what happened? The short answer is a lot of things changed. So bring Phil back in here to take us through what changed.
Sure thing, Nick. I mean, you could make the case that lenders really dodged a bullet on this one. And remember, at the time the CARES Act was enacted, the official unemployment rate was up there at 14%, which equates to nearly 21 million Americans. They wanted to work but couldn't find it. Unemployment, or even fear of becoming unemployment, led a lot of borrowers to opt for forbearance. Forbearance on recently originated loans drove EPD numbers way up. No one knew how long unemployment would remain high, and the risk that borrowers who opted for forbearance plans would be on the plan for so long that the missed payments would compound for so long, it'd be really difficult for them to recover. And the ultimate resolution would be default and or foreclosure. Well, luckily that really didn't happen for a number of reasons. First, EPD reviews mirrored the forbearance data. In May of 2020, about 4.7 million, or roughly 9% of the outstanding loans were in active forbearance. We've seen a steady decline since there, with only, 690,000 or so loans remaining in active forbearance as of today. So EPDs naturally declined as less loans went into forbearance, and some of the previous loans came out of forbearance. The agencies and the regulators also did their part, recognizing the problem and gave some relief to lenders by even relaxing requirements to review 100% of all the EPDs. And very importantly, the overall economy, and particularly unemployment, the rates rebounded very quickly.
So then really what happened is that the repurchase risk was in large part transferred to servicers via regulatory risk. Is that right?
Yes, yeah, sort of, yeah. A lot of that's still to be determined. I would first look at the positives. 92% of all borrowers that were on a forbearance plan have exited that plan. And we have Black Knight's data here that shows that 53% of those exits have completely reinstated and are now current. Another 29% have paid in full, meaning that 82% of all forbearance exits have reached a positive outcome. So why is that? Now, you've heard a lot about the economic conditions recovering rapidly, and that certainly is a big part of the reason. People remain employed or found new jobs. Engaging by our inflation numbers, they still have money to spend. Interest rates, they've remained low for much of 2021. So a lot of the forbearance exits, they had a refinancing option available to them. And in just about every locale, property values were skyrocketing. I mean, if it really came down to a choice of defaulting on the loan or selling the home, walking away with some appreciation dollars, that was also, and probably still is, a viable option for many people exiting forbearance. So overall, mortgage delinquencies remain very low. People need housing, and since the cost of acquiring new housing, that's either renting or buying, has gotten much more expensive. Homeowners are keen to protect their largest asset by not going into default and foreclosure.
Okay, so all seems rosy. Why did you say that a lot is still to be determined and decided?
Well, that's primarily because we still have 9% of those loans that have exited their forbearance and have not reinstated. That's a little more than half of those loans that are on an active loss mitigation plan and can hopefully move to a current status at some point. And that gets us down to a remaining portion of, I don't know, just over 290,000 loans that are out of forbearance. They're not current and they're not in a loss mitigation plan.
Yeah, and also don't forget that there are roughly 700,000 loans, like you mentioned earlier, that are still in a forbearance plan.
Absolutely, agreed. It's really those last couple of numbers that give you a little bit of pause. We've been able to hold off the pain thus far, largely because refinancing into a loan with the same or lower interest rate was a great option. And because the borrower had long-term unemployment or another permanent hardship, selling was always an option that could mean walking away with some cash in most cases. Now, the refinancing option, that's mostly unavailable now. The current interest rates would mean the monthly payments would in all likelihood be higher and maybe much higher. And selling, well, still an option. It gets more complicated by the fact that we all need shelter. And with rents and property values where they are now, the proceeds from any sale of a primary residence, it won't go as far. So this could be a difficult choice for borrowers to make. Getting back to the risk transfer from lenders to servicers, there's a lot of work that remains to resolve all of these cases. Work that needs to be done by servicers that haven't processed loss mitigation plans and defaults at any sort of scale since the end of the Great Recession back in 2010, 2011 timeframe. And I'm sure most of you remember, the CFPB statement that unprepared is unacceptable.
Yes, we do. Yeah, and I'm certain that they meant that servicers should expect a lot of complicated work to help borrowers save their homes, and that waiting until we reach the end of the forbearance to start getting people, processes, and technology in place wasn't a good idea, and to be proactive. And I think most importantly, what the CFPB meant by that statement is that we, meaning we being the CFPB, will be watching. So yeah, good points there. Let's transition away from EPDs and forbearances and look at interest rates from the borrower's perspective. In this slide, we looked at mortgage interest rates in three ways. One was today's interest rate, two was the average interest rate for all of 2021, and three was the lowest rate available during the latest refinance boom. That lowest rate was hit the week of January 7th, 2021. The goal here was to show the impact to the P&I payment for the average borrower. To get there, we assumed an average loan amount of $453,000. So before we get to the P&I payments, it's worth reiterating that today's average interest rate of 5.81% is 119% higher than the pandemic low when it was 2.65%. And today's rate is also double the average for all of 2021. So the calculations here really just math, but I think it shows the impact to the average household budget, in addition to bluntly showing why refinance volumes are off so much. As a borrower, if you were purchasing a home or refinancing an existing mortgage today, your monthly P&I payment would be $761 per month higher than if you were able to get the average interest rate in 2021. Today's P&I payment would be $836 higher than if you were lucky enough to get the same loan at the low point in January of 2021. So Phil, with these numbers, I think you can quickly see that something has to give here, doesn't it? And for the same house, 10 months later, borrowers are looking at a 40 to 45% higher monthly mortgage payment.
Absolutely right. I mean, there's no two ways about it. Homeowners are most definitely taking it on the chin in a couple different areas. The P&I differential that you noted here are huge. And that doesn't even take into account some other costs associated with owning a home. Just think about homeowners insurance. The pandemic did a number on the cost of raw materials, particular things like lumber and copper that are used in home construction and renovation. Costs for those items remain high, and they're key inputs in calculating the premium for homeowners insurance. By most estimates, the premiums for that type of insurance are up about 20% from pre-pandemic levels. And most homeowners have not adjusted their coverage to account for the rise in property values. If that was done more regularly, the premiums, they'd rise even more. And speaking of a rise in property values, if you live in an area that does periodic reassessments, your taxes have most likely gone up a material amount. Now, for now, we haven't seen much impact, but what concerns us the most is that there are multiple moving parts, and that could turn into problems, and as they're intertwined to some degree. We've only seen the impact of higher rates on volumes, but we're in the mortgage industry. We know the cycles, and we adapt to interest rate changes. We've been adapting to rate changes for decades. Where there is still some concern is with some of the things that we've talked about today. That credit box, it's getting a little looser to maintain volume. Now, that may cause some problems with increasing defects. Increasing costs make forbearance exits a little trickier. So these things can all converge. And if they do, we could see some higher delinquencies and loss metrics.
Yeah, I see what you're saying. I mean, our industry can manage through some things, but if one thing impacts another, it has the potential to start a bit of a chain reaction. And it does feel like there are a lot of things to deal with at once. There's a lot coming at us all at once here. And, for now, I feel like property appreciation is the magic elixir. It's really making all these other issues moot. We'll see how long that holds up. And, I think for me, that's one of the key metrics to watch here, because as properties increase in value, it really does give everybody more options of things to do to avoid problems with their mortgage. Well, we've talked about the borrower a lot and the headwinds that the average borrower is facing. I wanted to now take a look at the lender side of things. We looked at the SEC filings for 5 different publicly traded lenders, and we pulled some key data. We'll start with origination volumes. On the left side of this slide, you see lending volumes for 2021 for each company. The origination volume for 2020 is on the right side. As you can see, 2021 was a banner year for origination. The volume for these lenders was up 21% year over year. So we're off to a good start. The next slide, however, paints a little less rosy of a picture. The data on the left side of the chart shows the gain on sale margin for those same 5 lenders, comparing the average gain on sale from 2021 and 2020. And then in the graphic on the right side, you see the effect that gain on sale margins have on revenue. To be clear, the revenue numbers only include revenue generated from the origination portion of each company's overall business and doesn't include servicing or other income streams. So what we're trying to show here is that even in a banner year for origination volumes, with a 21% increase in originations, revenue was down 30%. And so that just tells you that the primary source of revenue on the origination side is the gain on sale. And as that comes down or moderates at the end of a refinance cycle, it really impacts the lender's income streams. Also, within just the past month, there were a flurry of filings for the first quarter of 2020. I didn't have an opportunity to include the numbers here, but the key metrics were similar. Origination volumes were slightly up from the prior quarter, and all 5 of the lenders saw a slight decrease in the gain on sale margin. The majority of these lenders reported nice profits, primarily because of large markups in their servicing rights. That should be noted too. Servicing is acting as a nice hedge for a lot of companies in this environment, and I think will be increasingly more important as interest rates continue to rise. But that's a topic for a different day. We really wanted to just give you a picture of both the borrower and the lender here, kind of to see where we've been and a little look at what we're facing going forward. Phil, with all that being said, help us bring it all back together.
Well, Nick, I think the best way I can say it is that quality control and compliance will never be more important than they are right now. Essentially, it's every QC leader's time to shine. It's clear we are in a different cycle than we've been in the past few years. It's definitely a time to be redoubling down on your QC efforts. Just with some data out for the month of April, we see the credit box is widening, something that you would expect to see as lenders scrap for each additional dollar of volume. This data looked at agency-backed mortgage-backed securities, and we saw the average credit score was 751, just down slightly from March. Debt to income ratios are creeping up a little bit, up to 36%. Loan to value ratio is also creeping up a little bit, 82%. Now, none of those metrics are screaming red flag at all, but they are showing that the margin for error, it's getting a little tighter. The easier to underwrite products like the rate and term refinances, they're going to be few and far between. Going forward, in addition to purchase lending, we are going to see cash out refinances, and we'll see HELOCs where there will be the refinance business, but that's where it's going to come from. Each loan, it's going to be incrementally harder to get qualified. The most recent estimates that we have is that the homeowners have around $446 billion in untapped equity. Many will still want cash, but they're locked into these low rates they got from refinancing in 2020, 2021. So second lien lending, in all likelihood is going to surge. And I would think that we're going to see that in the form of both closed-end seconds and HELOCs. So what does that mean? Well, it means new products, new guidelines that are going to need to be incorporated into your QC plans and your processes. And depending on the delinquency stats we see going forward, we may even see a return of much more investor overlays. So quality control managers are going to need to be nimble. And those that adapt their processes, they're going to deliver results that'll make a positive impact on their company. And lastly, in the middle of all this transition, all the goings on, the CFPB, they've signaled that they are getting back to business as normal. That means resuming on-site reviews, more regular data transmissions, and most likely a focus on consumer complaints. Compliance will therefore be unbelievably important. Director Chopra testified in front of the Senate Banking Committee back late April, and surprisingly enough, mortgage lending was not a key focus of his testimony. He mentioned the Bureau's intent to shift focus away from small firms and instead focus on repeat offenders and large players engaged in large-scale harm. Again, he did not mention mortgage companies in that regard and only named specific firms that served larger segments of the financial services space. But what is clear from his testimony overall is that the CFPB is watching the servicing industry specifically. And near term, that means the remaining borrowers still in or recently out of forbearance plans. But if delinquencies move upward from where the multi-decade lows have been, you can expect some scrutiny in the processing of loan loss mitigation and foreclosures going forward. There really wasn't any specific focus on the originations front, which was welcome. There was some mention of algorithms and the Bureau's desire to ensure the bias is taken out of the algorithms. The director also mentioned credit scores in the bias context and went a little further by saying that Bureau recognizes that medical debt is often the largest factor in people's credit scores and a desire to see what changes could be made on that front.
Yeah, it makes some amount of sense to me that the CFPB is starting to reassert itself a little more. That's something that could be expected just with a new administration coming in. I think overall in our industry, the mood is a little more somber. There's no question that we're in a period of transition. And it makes sense to me that all of us here embrace the change that is to come and recognize that we can individually make a difference in loan performance. One thing that piqued my interest about what you said is the degradation in credit quality or the average borrower profile as far as credit score, debt to income, and loan to value metrics. I think those stats bear watching going forward. So this last slide here of this section sounds like a warning. And although it's not intended to be one, we do think this transition period in the market is the opportune time to get even more serious about loan quality. One number that didn't get talked about a lot is the volume of repurchases. Because the market was so good for most of 2021, there wasn't a lot of focus on Fannie and Freddie repurchase. But that number amounted to $2.97 billion for all of 2021. It's a little bit shocking, isn't it? I mean, not just for the sheer dollar amount, but also because it's so large and we didn't hear much about it. Lenders were very profitable, I guess. So repurchases were looked at as a cost of doing business. Maybe you just didn't hear a focus on it that much. I think also it should be noted that $2.97 billion figure is up 76% from 2020. That's according to statistics that Inside Mortgage Finance put out. So, Phil, with repurchases being up, what should everyone get focused on?
Well, one thing that we've recently heard from the GSEs and other industry participants is that lenders aren't focused enough on the spread between gross and net defects. Fannie Mae actually tracks these metrics and posts a lot of data around them publicly in the loan quality section of the website. The feeling is that the defects have been low for several years, going back to even pre-pandemic, and that lenders are becoming complacent with defects, believing that a lot of things can be fixed on the back end, and thus stemming off repurchases or other problems. But that can be a sloppy way of doing things, and the sloppiness could lead to growing risks. And an additional nuance here is the non-critical defects. Again, another indication that the manufacturing process has flaws. Lack of attention to moderate and other defects can escalate, leading to an overall origination process that puts a lender at even greater risk of repurchases. Any increase in the spread between gross and net defects and or amount of non-critical defects, it should be viewed by lenders as a problem and addressed appropriately through a QC feedback loop for the origination group and action planning. These are crucial considerations in an effective QC operation.
Yeah, and Sharon is going to take us through some new reporting that we've developed recently to help lenders react to these problems. So I don't want to steal too much of her thunder, but what I will say is that Fannie in particular puts out a lot of relevant information and data for the quality control space. So I think it's incumbent upon all of us to be rabid consumers of that information and to use the tools available to inform QC policy. And QC is the last line of defense by definition, and that's going to be even more important going forward. Inflation, interest rates, the war in Ukraine, all of these things mean things as we knew them for the past couple of years will change or be different. And that's okay. We've been through it before and come out stronger on the other side of it. And, I'm confident that we will this time too. With that, I'll conclude the QC Trends portion of this webinar, and I will turn it over to my colleague, Sharon Reichert, to take you through some of the GSE changes and reporting that we've developed.
Thanks, Phil and Nick, for a very informative look at industry trends and more specifically, how important quality control continues to be as we navigate through yet another set of challenges. As the dust settles on the last 2.5 years, we will see a continued increase in regulatory and investor scrutiny that makes a strong QC program all the more critical to protecting the bottom line. Today, I am fortunate to share some positive news coming out of our GSEs. As a 30-year veteran of the industry, with a vast majority of my time being spent in QC, I've lived the struggle to obtain solid and consistent guidance on what the GSEs are expecting from a reporting perspective. As we see with our own clients at ACES, we are all willing to put in the effort, but we need guidance that takes the guesswork out of report production and delivers the consistency and insight to provide the type of data the GSEs are looking for. In the last 18 months, we've seen a big shift in QC guidance on the Fannie Mae front. It appears that Fannie is adjusting their approach to provide more explicit examples and helpful hints on how to build out a successful QC program, both on the lender and vendor side. This includes the enhancement of their online presence and the introduction of their periodical, The Quality Insider, and on-demand Lender Bootcamp webcasts. There's a great risk management self-assessment tool, and word has it we'll be seeing an updated Beyond the Guide in the not-so-distant future. All of these resources are publicly available and are located with a quick Google search for Fannie Mae loan quality. Two of the resources I'm highlighting today are the November 2021 boot camp webcast titled Improving Loan Quality Through Effective QC Reporting, and last month's Quality Insider article on strengthening your QC program, QC reporting. Now, I can't go through everything outlined in these resources, but I will highlight some of what I consider to be the most important and often the most missed. Keep in mind, the report samples I'll be showing are those we built in ACES for our clients, so they will differ a bit from Fannie's samples. I have been a long-time proponent of building a leveled report deck so that each level of management within your organization has a report that is tailored to their specific needs. A report that is hard to read or doesn't provide key data elements important to the reader really isn't worth the paper it's printed on. Fannie has specifically called out the need for 3 unique reporting formats: the senior management, the middle management, and frontline management. Here are a couple of examples from the senior management report. Note, we're using consistent colors and terminology throughout all 3 of the reports. In the senior management report, we're focusing more on net defect rates and breakouts by audit types, such as targeted, component, discretionary. You get the idea. Whereas in the middle management reports, we're analyzing along business lines. Gross and net defects have always been important to Fannie, but lately we've seen renewed interest in the gross defect rates. Curing defects and bringing your net defect rates to what might be considered a respectable level doesn't mean you're solving the problem. The amount of time and resources spent correcting errors is much more costly than correcting the process that caused the error in the first place. Keep your eye on gross defects and be sure to use your action plans to mitigate those errors the right way. Some other items of note on this particular table from the senior management report includes the total loan amount of significant defects and estimated potential loss. Monetizing QC defects are absolutely critical to supporting how important not only the QC process is, but the permanent resolution of the errors identified. Connecting your QC results to fraud investigations and investor-related audits are also a great way to show the entire life cycle of a loan as it relates to QC. As Phil and Nick highlighted in their presentation, viewing trends over different periods of time are critical to identifying emerging issues before they become costly mistakes. On the positive side, a rolling 3-month, 6-month, and even 12-month trend will also show where adjustments identified and resolved through the QC process improve over time, thus showcasing the importance of QC's work. In this example, we're comparing our actual defect rates with our target defect rates. Now, people often ask me, what is the industry standard for target defect rates? Well, it's a lot more complicated than looking at your neighbor's work. You have to evaluate your own organization's risk appetite and adjust accordingly. In fact, the GSEs don't dictate target defect rates. They only state that they be set reasonably low. The thought being that target rates will be evaluated from time to time and will hopefully be adjusted in a downward direction. Keep in mind, the GSEs and investors are not looking for perfection, but they do expect you to learn from your mistakes and encourage a culture of self-assessment and continuous improvement. Using strong and consistent defect categorizations are an absolute necessity for impactful reporting. Trends mean nothing if you can't identify the root cause of the issue. In ACES, we support Fannie, FHA, and custom defect categorizations, including regulations and citations. Being able to drill down to different levels is what will help your middle and line managers correct issues more quickly and more completely. Here are a couple of ways we're using our Fannie Mae defect taxonomies to drill down to the root cause. I strongly encourage you to work with your production partners to make sure you're presenting the data in a way that is most valuable to them. Speaking of the importance of categories, hopefully you saw the Fannie Mae selling notice on quality control calibrations last month. Included in their loan list template is a number of fields to capture both the lender-defined defect categories and the Fannie Mae's defect categories. If you're not currently using categories, you will definitely want to start working on implementing them because Fannie expects this data to be available to them by Q4 2022. And as you know, time is flying these days, so it's just around the corner. The last component we'll discuss today are action plans. In my opinion, action plans are the cherry on top of a robust risk management program. They aren't fancy and they aren't cool or particularly pretty from a reporting perspective, but if used effectively, they have the power of proving to your investors and regulators that not only do you have a successful risk management program, but your teams know how to actively search out opportunities to improve. Self-identifying risks and building action plans to mitigate those risks is a cross-departmental responsibility that will only help you in the long run. Fannie Mae makes action plans a required part of their report deck in both the senior and management reports. I think of it as a common sense approach to solving a problem. And if you think about it, action plans are really project plans. Be sure you're using a tool that allows you to collaborate across multiple departments and provide the level of visibility required for monitoring accountability. We've seen our clients use our action plan tool to track MORA and other external audits, as well as interdepartmental projects that require strong collaboration, tracking, and reporting. Action plans are so much more than tracking QC findings. In conclusion, I strongly recommend you take a look at the new and improved Fannie Mae Quality website. While you're there, be sure to take a peek at the Quality Insiders and Bootcamp webcasts. They are chock full of great information to enhance your QC program and your reporting. Track down a copy of the June 22nd Fannie Mae selling notice so you can start upgrading your data to include the full list of defect categorizations. And from a reporting perspective, plan on building a leveled report deck to address the unique needs of senior, middle, and line managers. Be sure to accurately calculate your gross and net defect rates, paying particular attention to the gross defects and what process improvements can be made to eliminate them rather than cleaning them up as they arise. Use 3, 6, and 12-month trends to ferret out emerging issues and celebrate the corrected ones. Categorize, categorize, categorize. There is no better way to drill down to the root cause than by grouping defects along like attributes. And finally, action plans, the cherry on top of the robust risk management program. Action plans should be driving improvements in a collaborative environment, holding the right folks accountable for making the necessary changes to reduce your risks and improve your company's bottom line. And remember, action plans aren't just for QC identified issues. A good action plan tool allows you to use it for all sorts of projects, including external audit preparation and self-identified issues, just to name a few.
All right. Now, I want to thank our panelists for going through all of that. And I want to have all of you pop up together now so that we can go through some Q&A from our audience. And before we jump right into the Q&A, I want to give our audience a couple updates as I saw some of the things that were coming in as far as questions. If you would like a copy of the deck that was used today in in today's presentation, you can reach out to info@acesquality.com. I will be dropping in that link in the chat in a moment. And for more information about what was shared today, you can use the web address at acesquality.com. But now to ask some questions to our panel of experts. The first question that I have for y'all, why is categorizing defects important?
I'll take that. So as I mentioned earlier, categories are huge, right? It's the ability to chunk up the data. Otherwise, it's going to be way too overwhelming. So if you really want to drill down to what's most important, what you're going to be able to fix, where you have opportunities to improve, then you're absolutely going to want to use categories. And as a reminder, for those Fannie lenders out there, categories are required starting Q4 for QC calibration. So you're going to want to go ahead and adopt that as well for that reason.
All right. Our next question is, what surprises you the most in the QC trends results?
Yeah, I can take that one. I would still go back to the subcategory information where documentation problems were the biggest root causes for defects associated with assets, credit, and income categories. I think that's slide 11 in the presentation. And Phil talked about it a little bit in the presentation as well, that we would really have expected that those problems would have dissipated and subsided as the pandemic, came to an end. I know we're not probably technically out of the pandemic, but as things got a little bit back to normal. So I would say we're going to watch the root causes more closely going forward. The hope being that with turn times getting back to normal, that we should see missing and expired documentation problems related to assets, credit, and income become less of a problem. And obviously, when they become less of a problem, they impact the defect rate in that category and their associated subcategories. So if we see that documentation problem persisting, that would be, at least in my mind, an anomaly that, and signify maybe a larger problem with just the overall manufacturing process that people should look into further.
All right. The next question, and I just want to remind our audience, continue to submit questions. If there's anything that we don't get through before this hour is up, the ACES team will be able to reach out to you after the webinar is over. So send as many questions as you can come up with, and you will get answers, I promise. The next question I have for y'all is income and employment increase. So what do you think contributed to the increase? Fraud by borrowers, underwriting calculations? What do you guys think?
Yeah, I mean, I'd love to hear Phil's thoughts too, but I can talk to at least the data. If you look at that subcategory information, again, the root causes for those things, a little bit less than half of those problems were documentation related, missing expired documents. The second highest subcategory was the calculation, right? The debt to income calculation being completed incorrectly. And then lastly, income eligibility. I would think that we see some more of the eligibility problems going forward. Things like counting overtime or miscalculating how much of commissions or non-standard just wage income goes into the calculation. So those are the areas that made up the defects. As I stated in the previous question, I think we hope to see the documentation part of that decline, which was the largest part. But as we get towards the end of a cycle and folks are trying to qualify every loan to maintain volume, you could see some increases in that eligibility quadrant there within the subcategories. Phil, I don't know if you have any comments on like the fraud part of it or anything, but I don't know that we saw that in our data.
No, I think as of yet we haven't, but I think you're spot on. There's a lot of documentation issues that have been prevalent, and I think with reduction of that, hopefully we'll see a reduction overall. But those eligibility issues, those are big, and I think as you look at, even as we went in further into some of the recent repurchase activity from the GSEs, of this income and employment becomes a key one. That you look at your types of defects, and they're all critical defects, but they're not all created equal. And you get to the ones that really can cost you employment and income become ones that they truly can result in those repurchases. So I think an emphasis of everybody pushing towards that, knowing it's a tricky part, especially with the more complex loans, that we really need to improve on that process of qualifying eligibility and make sure you are good there, just to protect your organization from that repurchase risk.
Unfortunately, we're at the top of the hour and we've come to the end of today's webinar. I want to thank our panelists, Nick, Sharon, and Phil, for taking us through today's information on QC trends and how to prepare the next generation of GSE reporting. And I want to thank our attendees for joining us today. Now, the webinar will be available at HousingWire.com in our Knowledge Center, and a recording will also be sent to all of the registrants. Now, once again, you can request a copy of the deck that was used to today's slide at info@acesquality.com, or you can visit the acesquality.com website for more information. Thank you for joining us today. Hopefully we'll see you all again soon. Thanks.